welcome to the Capital Market Program on Channels Television. I'm Edidiong Iwang. During the week, the National Council of the Nigerian Stock Exchange announced chief executives to head its operating and non-operating companies when the ongoing demutualization exercise is completed. According to a statement by the NSE, the Nigerian Exchange Group PLC will be headed by Oscar Onyema as Group Chief Executive Officer, while Temi Popoola will assume office as the CEO of Nigerian Exchange Limited. Also, Tinuade Awe has been appointed to head the NGX Regulations Limited as the CEO. The exchange noted that although all the entities have been duly registered at the Corporate Affairs Commission, the appointments are subject to approval of the Securities and Exchange Commission. Members of the NSE had in November 2020 unanimously voted to support the listing of the Nigerian Exchange Group on the NSE. Meanwhile, the NSE has also inaugurated a 5-man claims review panel in preparation for the exchange's imminent demutualization. A statement released on the NSE's website revealed members of the panel to include Mr. George Etomi as the chairman, Mr. Seni Adio, SAN, Mr. Bacha Bulama, Dr. Paul Anabana, SAN, and Prince Agisi Eredua. The exchange says the panelists are individuals with the required expertise and extensive track records of integrity, excellence, and achievement in their respective fields of specialization. The panel will serve as an independent alternative dispute resolution mechanism for the review and determination of claims made by individuals or entities in respect of any assertion of rights in the shares of the demutualized exchange. In addition, the panel will perform an adjudicatory role by acting in an appellate capacity for dissatisfied claimants who object any decision of the National Council of the Exchange on a claim pre-demutualization or the board of directors of the holdco after the demutualization process. Moving to the markets now, the first trading week at the equities market in the new year ended on a negative note, with the all-share index falling 0.37% to 40,120.22 points. The year-to-date return on market capitalization settled at minus 0.37% and 20.97 trillion naira respectively. Performance in the markets was largely driven by profit-taking on bellwether stocks in the cement and banking sectors. Now, volume and value traded declined by 17.48% and 42.55% respectively. The most traded stocks by volume were Transcorp, Axis Bank, and ICO Insurance, while Zenith Bank, GT Bank, and Axis Bank topped the value chart. Sectoral performance in the week was broadly bullish, with 4 of the 5 sectors recording gains. Banking, consumer goods, oil and gas, and insurance sectors appreciated, while industrial sector fell by 2.29%. Well, it's a different picture at the unlisted securities markets, where the NSI rose by 1.15% at the end of the first trading week in 2020 to 741.54 points, while the market cap rose to 532 billion naira. Volume, however, declined from the previous week to 111,434 units, worth 15.210 million naira, traded in 13 deals. To the fixed income market now, performance in the bond market was largely bearish this week as investors are embarked on a profit-taking in expectation of the Q1 2021 bond calendar. At the close of the week's trading session, yields at the long end of the curve fell the most by 46 basis points, resulting in a 31 basis point reduction in average benchmark yields. On Friday, however, there were 7 deals worth 2.47 billion naira. Well, performance in the Nigerian Treasury bills market was bullish for most of the week, and the CBN reported a 62% drop in its Treasury bill sales in 2019 to 7.77 trillion naira. Now, notable volume was traded mostly at the short to mid end of the curve, as average benchmark yields fell by 2 basis points to 0.38%. However, on Friday, there were no deals at the Nigerian Treasury bills market and the CBN special bills market. The OMO market, on the other hand, saw 24 deals worth 15.11 billion naira on Friday. Now, still talking about the markets, I'm being joined now by to get more market perspectives and projections for the Nigerian capital market this year. And I'm being joined by Dr. Peter Elege, the Chief Executive Officer of PFI Capital. Good evening, Dr. Elege. Thank you for joining us on the program.
Thank you, Young.
Well, let's still talk about the markets. Now, the equities market ended 2020 with a 50% return in year-to-date performance. Now, let's get your review of the stock markets last year. How would you say the Nigerian stock market performed?
Yeah, thank you for having me, Young. The Nigerian stock market performed very well last year. It basically was the best performing index for the year 2020. It opened the year at 26,000 points and closed about 40,000 points. Market cap gained over 8 trillion. Compared to global indices like the S&P, the FTSE, Dow Jones, and the Nasdaq, right? They did well. However, compared to them, the Nigerian Stock Exchange did much better. The S&P rose by 16%, FTSE dropped by about 14.34%, Dow Jones increased by about 7%, and the Nasdaq increased by about 43.64% as a result of the tech stocks that basically did well last year. It was driven basically by domestic investors. We saw increased participation in PFAs last year. More local institutional investors participated in the market last year. Domestic investors were increased compared to 2019. It increased from 51% in 2019 to 65% in 2020 domestic participation, whereas the foreign participation in the market declined for about 48% last year to about 34% in 2020. Sectoral performance. The industrial sector did the best. It rose about 90.81%, driven by Boa Cement, driven by Dangote Cement. The consumer goods sector didn't do very well as a result of the lockdown. It dropped about 329 basis points. Banking sector rose about 10.14% in the year. Oil and gas declined as a result of the challenges in the downstream sector, while the insurance sector did reasonably well by rising about 50.61% during the year. The key drivers for 2020 was as a result of the dovish stance of the CBN monetary policy. Yields were declined, and basically investors were looking for value. So reallocation of capital happened. Monies moved from the fixed income sector into the equity sector. Dividend yields were projected to be higher than, of course, the expected returns from the fixed income sector, and that's why you saw reallocation of capital and basically more liquidity in the market to drive shares up. Also, the impact of the coronavirus vaccines. So the vaccine came out, and basically what it means is an effective vaccine would see normalization of business activities, and basically growth in the market. And the election of the new president in the United States, it basically brought optimism in the capital market for last year.
Dr. Elege, I'd just like to get your scorecard for the fixed income market last year. I mean, we saw yields drop even to the negative in, for example, the Nigerian Treasury bills market. So how would you rate the fixed income market last year, given the low yield environment?
Yes, so as a result of when yields drop, prices of the bonds go up. So looking at even at the S&P FMDQ sovereign bond index, it rose by about 39.17% last year, gaining about 189 points during the year. But average yields dropped across all maturities. The average yield was about 660 basis points. The average drop in yields across all the maturities was about 660 basis points. For some maturities, you saw yields drop as high as 755 basis points during the year. Market cap of the bonds, also increased during the year as a result of the, increase in prices in the bonds. In January, we saw market cap of FGM bonds at about 10.29 trillion. As at December, it rose to about 15.26 trillion, where the outstanding bonds was about 10.67 trillion. However, market turnover declined. What it means is that trading declined in the fixed income space. It declined from about 30 trillion in January to about 16 trillion in December.
What are your projections for the equities market? I mean, you've given your review of the market last year. For the equities market now, what are you expecting from that segment of the market this year?
We expect the same drivers of the equities market last year to continue this year. We believe that people that missed out from the rally in Q3 and Q4 last year will want to participate and basically, participate in the rally this year. Expectation of results, we'll soon be getting results for the banks in the coming months, in the coming weeks to months. So we think that will be a trigger for the markets this year. As a result of the optimism now in the market, some corporates will come in to basically want to take advantage of raising capital in the market, in the equities market, and also listing new shares in the equities market. And we expect the CBN policy to continue, the dovish stance in interest rates. We expect the low yield regime to continue. And as a result of that, we think that it would basically cause the equities market to basically continue the rally this year. And a Joe Biden presidency is good for emerging markets, it's good for frontier markets. US is likely to step down from the policy of protectionism. This should improve global business environment. Portfolio flows are expected to increase into the emerging and frontier markets due to the low yields in the developed markets. This should lead to also a weaker dollar. And what I should mention here too is the market could go either way, both ways, and it should be as a result of the vaccine. So we've been hearing of recent of the new strength of coronavirus out there, right? If we see the vaccine as effective in basically taking care of the coronavirus, then normalization of business activities will be there, and of course, growth in the market. But if the new strength, if the vaccine is ineffective, in curbing the new strength of the COVID-19, then we may go into another economic shock, which would lead to further, of course, lockdowns, decrease in global output, weaker retail demand, weak oil prices, and all this basically are not good for the markets. It could even increase inflation, particularly in the emerging and frontier markets, and of course, decline in capital inflows, which would negatively affect our external reserve. And this is all negative, basically, for the equities and fixed income market.
Oh, Dr. Lega, we really do hope that the vaccine, is really effective, because the economy, I don't think any economy right now can withstand, what we all went through in 2020. But those projections for the equities market seem, positive. But could you just talk briefly in about 2 minutes about the fixed income market? What should we be expecting? Are we still going to see the low yield environment in that space?
Oh, yes. So, our expectation is as we still think the low yield environment will still exist in this in the market, but it has to do with a lot of things. We expect corporates to come out this year to raise more money from the corporate bonds market and of course the corporate commercial papers market. Last year we saw corporates raise over 600 billion, from the commercial paper and the corporate bond market within the ranges of single-digit rates, 1 to about 7%, taking advantage of the low yield environment. And we think this is going to continue in this new year. We expect the federal government to take advantage too of the low yield from the Eurobond space. We have a maturity coming towards the end of this month for an Eurobond coming towards the end of this month. So we think the federal government should take advantage of the low environment to refinance its Eurobonds. Yes, so that's what we expect in the market. And we think there may be some increased pressure in the fixed income local bond market because of the deficit budget of about 5.2 trillion. We think federal government is going to increase borrowings and may make yields to rise marginally.
All right, Dr. Lege, please hold your thoughts. Capital Market continues in just a moment. Please stay with us. Welcome back and thanks for staying with us on the program. Dr. Peter Elege, the Chief Executive Officer of PFI Capital, is still with us on the program. Doc, thank you for staying with us on the program. Now let's turn our focus to the foreign exchange market now. What is your review of the market in 2020? What was inflow like? How did all the CBN policies impact that market? And just give us your projections for that market for this year as well.
Thank you, Didion. The FX market had a lot of volatility last year, as a result of declining external reserves, the coronavirus issues, and basically there were a lot of restrictions with respect to moving dollars from one account to the other, and it basically caused a lot of panic in the system. However, the CBN came up with more policies to basically try to unify the different rates in the different segments of the FX market. One of those policies is the IMTO policy, in which people can receive dollars, instead of naira when it's being transferred from diaspora. And basically what it did was to help narrow the spread, between the official rate and the parallel market rate. What we think is going to happen in 2021 is that the CBN would keep on trying to unify these rates, to ensure that there is stability in the market, in the FX market.
The CBN now, I mean, the CBN rolled out quite a number of policies in the market last year. How would you say the market welcomed those policies, and what impact did it have on the market?
Yes, so as I said, one of the policies is the IMTO policy. Another policy is the fact that there was a depreciation in the FX rate for BDCs, what they could sell to, to the end users, and basically those are the key policies in the FX market, they also did policies with respect to, trying to increase, lower the yield in the money market space, and also to increase the money supply in the system, basically to stimulate growth, to stimulate economic growth, which we believe, has had a lot of impact. As I said earlier, in the last couple of months, the number of corporates that have raised capital from low yields has tremendously increased, and I think there's going to be a multiplier effect in the economy, which I believe is the right step in the right direction.
Just quickly talk about mutual funds now. How did that segment of the market perform in 2020, and what's your outlook for 2021?
Okay, so the number of mutual funds grew significantly in 2020, and it's as a result of the expansionary monetary policy by the CBN. We noticed that the number of mutual funds grew significantly because investors were looking for basically for value as a result of it. So initially, the government, because of the high yields in the fixed income market, in government bonds, a lot of private sector participants have been crowded out. But now with the low yield environment, what has happened is that a number of people are now being forced, to invest in other type of assets outside, the fixed income, federal government fixed income assets. So what it has done now, it has basically caused reallocation of capital, reallocation of funds, from fixed income investing into mutual funds investing, because people are basically looking for value, for increased return of investments. So most asset managers basically had significant growth in their assets under management.
All right, Doctor, let's turn our focus to PFI Capital now. How was 2020 for you as a company? I mean, given the coronavirus pandemic, the lockdowns, the NSAS protests, and the lockdowns that followed that as well. How did PFI, weather through 2020 as a year?
Yeah, 2020 is a year of mixed reactions. The first quarter of the year, there was a lot of panic in the markets, in the financial markets. Basically, there were a lot of sell-off, and it basically caused a lot of panics with investors. when we realized that the coronavirus, COVID-19, was going to become a pandemic, what we did basically for our investment portfolio was to reallocate our portfolios to ensure capital preservation and, of course, growth. And, of course, be able to take advantage of opportunities that may arise. As you're aware, the fixed income market and equities market basically did very well last year. And good thing for us and for our clients, we participated in the growth of these markets. During the lockdown, there was a lot of challenges a number of people face, particularly moving around and getting things done. So what we did was basically to employ technology to ensure that we deliver efficient services to our clients. What we did was to create wealth for our clients, and to ensure that they have access to safe and efficient services.
Now, I mean, it's a new year, and I'm sure a lot of lessons were learned from 2020. So what should we be expecting from PFI Capital this year? What products, what services, what is the plan? What's the scorecard for the playbook, rather, for 2021?
For PFI Capital, what it is for us is we want to be a destination of wealth creation in SSC. That's our target. And what it is, how do we achieve this? Is basically by creating innovative investment solutions for our clients, trying to give them accessibility to different markets, ensure that they get the best quality services. Digitalization is part of the processes we're going to use to achieve this. We're trying to digitalize all our operational processes, and also even our investment processes, by employing AI even to investment decision making. The point is to make savings and investments safe, convenient to all our clients, helping them create wealth and helping them to achieve their different investment goals and objectives in different facets of their life.
Well, we hope that everything is, worked out properly. But what aspect of the market do you think regulators, exchanges, and the government should focus on this year? I mean, we need to improve the Nigerian capital market. So what do you think they should be focusing on in 2021?
So, for instance, the SEC, the focus for the SEC is primarily investor confidence, to promote investor confidence, and protecting investors, by providing adequate regulatory and supervisory services. And for the CBN, what they have been doing and what they've been trying to do, is to basically focus on price stability. So, which is basically trying to reduce inflation. Exchange rate stability too is very important, and encouraging financial stability in the system using the various monetary policy tools available to them.
Doctor, thank you so much for your input on the program. Dr. Peter Elege is the Chief Executive Officer of PFI Capital. Thank you for giving us your insight this new year.
Thank you, Didion.
Well, that's all on the program tonight. Thank you for watching. I'm Edidion Iwang. Do remember to stay safe.